T. Rowe Price out with a note today saying the benchmark 10-year yield could climb as high as 6%, a level last hit in the year 2000. Strategists outlining a number of fiscal risks at play, including a growing federal deficit fueled by Trump tax cuts, plus potential tariffs and immigration policies that could put even more pressure on prices. Rates have been climbing already this month, topping 4.4% at their highest today. But if T. Rowe Price is right,
Price is right, yeah.
Oh, yeah, I think that's why I said it.
Yeah.
What could it mean for stocks? The major indices, well, down today, they're still trading close to records. Even the Dow logging its longest losing streak in more than 4 decades. It's less than 4% off its intraday high. Can the strength continue if yields push higher, Tim?
Well, a little higher, yeah. And remember, growth scare would push yields lower, and that's not good for the equity market. Where were we in September and October? You had a couple bad payroll numbers. People were starting to question what was going on with the economy, and that's a lot worse for equities to me than a 10-year that could go to 5%. And if it goes to 5, I mean, who knows what the psychological level is? There's a lot of empirical data, and there's certainly a lot of history attached to when 6% was. And we were a very different rate environment back in 2000. By the way, 2000 is also where we were the last time cash levels were this low on the equity market. So if you listen to Merrill Lynch, Bank of America, and their fund manager survey, you know, we're at a sell signal in terms of equities, in terms of cash levels are low. Optimism is high. So I'm not suggesting it's 2000 both from a rates environment or necessarily an equity environment, but it does tell you where we are. And I think from an economic perspective, with the Fed on deck tomorrow, you've got BOJ this week, you've got a lot of CPI data. I think it's a case where we want to see yields hold this level. I think I'd be very comfortable as an equity investor with yields up closer to 5%. Again, given the environment where we know the next administration has discussed dynamics that I think will be, frankly, yield friendly, meaning yields higher friendly. Go back to July of 2020, and you could make an argument that rates have been slowly moving higher on the 10-year. There's been some fits and starts. Carter would tell you they've done nothing in 3 years. I think that 5-year chart tells you there's upward pressure.
5% on the 10-year, that's fairly consensus out there. I mean, ING has that 5% mark, JP Morgan Asset Management. I mean, a number of shops out there have 5% baked in for next year. But I guess the question is, you know, the T. Rowe note indicated a lot of sort of technical reasons why the 10-year would go to, including other countries not wanting to buy our treasuries. And so does that matter that it's those factors that would drive yields higher?
Well, you'd want yields to be higher because the economy is doing well, right? Obviously, you want that, and that's the scenario you're talking about, where yields are higher because things are sort of, you know, the economy's growing and growing nicely. That 6% number, though, I think that starts to get into a bad spiral, right? And if the government needs to fund itself at 6, right, we're at, I think our average debt now is maybe 3.3. At me if that's materially wrong, but that's a very significant shift. So that they aren't talking about 6 right away, sort of a stop at 5 and then it could move to 6. That 6 to me is a scary scenario. But I think the market can handle 5 if it's sort of for the right reasons, not Japan pulling back, China pulling back as buyers of U.S. debt.
Yeah. Julie?
Yeah, I agree. For the right reasons is the really important distinction to make. If you think about where we are right now, there's a lot of enthusiasm, obviously, in the equity markets. And part of it was driven by lower rates, but part of it, too, is just the strength of the fundamentals. I think I have concerns for particularly what we see in small cap. A lot of these smaller businesses are impacted by higher rates. Many of them are not able to finance on, you know, long-term debt. They are typically on variable rate debts with their banks. And so that could be a real headwind for small cap. And so I think overall, it's not a terrible thing if we're at 5%, but it will hurt some businesses for sure.